Dan, how are you doing, buddy?
Doing amazing. Thanks for having me on. How are you?
I'm doing great. Thank you for joining me. Okay, let's start with the basic stuff, right? What's the map behind you? What are
This is a map of the Thames River in London.
That's a Thames. I should have recognized it, although it's too far away for me to look at as I look at the screen instead of the camera.
I
Should have
do a lot of
recognized.
tra
That's
I do a lot of travel to the UK and London, and I saw this in a store and I thought it looked really cool, so I got it for my office. But I'm not in London.
it is cool. I love the fact that it's broken to three different frames. Isn't your co-founder from England or London or
Yeah, my co-founder David Dacius is based in the UK, just south of London. He's in Brighton.
Okay, we don't discriminate against people from Brighton, Kent, Essex, or whatever is north to London. I've been there
Scotland.
once. So
Scotland.
no, 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 no. We love Scotland. You have the in between. Now, there are people that will argue that Manchester is one of the best um, football teams. I will not disagree. There are many, many, many great football teams out there. Soccer. Um, and I will not, I will not have it, speak or any opinion about it publicly. Yes. Yeah, it can be dangerous, I think.
So I don't follow the Premier League, but I'm obsessed with World Cup, and we have the World Cup coming to the US next year.
I know. I
So, and
know.
and it's going to be Los Angeles and New York. So we have to figure out if you figure out a way to get tickets, we need to figure this out.
I was, yeah, we have that. We have the Olympics. They've been working on LAX since I moved here. So for the past more than a decade, and I'm talking about moving to Los Angeles, not to New York. Or they've been working on the subway system, on a train that will take you out
What
and
subway
into
system?
LAX. We have a subway system. We do have a subway system. As far as I know, part of it is underground in downtown LA, and frankly, I've never tried it because it's not really accessible everywhere. However, if you're in downtown LA, only after 5 connections and almost an hour and 10 minutes, you can reach LAX. I never
Amazing.
tried it.
So
That's what I read. But
the
that's
the
public transport.
the the U in LAX from all the terminals over there. I'm really concerned how they're going to get all these people through that U because this is when it's bad. For those that haven't been to LAX. There's like a little U, a road with all the terminals that is in the shape of a U. I think it's
Mhm.
about a lane and a half wide, and it could take probably 2.5 hours to get from one end to the other on a bad day, right?
It can take a while. Yeah. You need to know, first of all, uh, are you taking the arrivals or the departures? And you can play it, by the figure out what time of day it is, because then you have traffic to the airport and traffic inside the airport. Then you have the shortcuts, because sometimes you don't want to do the entire U. You go like, I need to pick up a friend or drop off my wife. It's Terminal 5. I'll take the shortcut at 5 or 6 and just walk a terminal, which is not that much. We're talking about 200 meters at best. Yeah, no, it can be a challenge for people without patience. And those are actually 4 lanes. You have 4 lanes,
Four
not
lanes.
not including the lane that is like inside but you have enough LAPD or traffic or airport PD, whatever it's called, that keep on moving, don't stop, carry on, just don't
And there's a
block
there's a new
traffic.
monorail too, right? That they're building.
That's the idea. That's the idea, that you can take the monorail, or what I mistakenly call the subway, that you can actually take the public transportation
It's gonna be amazing.
from. Yeah, the question, where does it actually go? Can you connect? to
I just
somewhere
want to get away.
else,
I just want to get away from the you. That's the only thing I want is being able to move
walk.
away from the you.
You just walk, right? You just need to walk. There is no other option. Okay, listen. Actually, if we are talking about just nonsense, LAX, public transportation, now we have in LA Waymo and we have a lot of, well, it's been Uber, the taxi drivers, that's always been a kind of a nightmare. But Waymo has been doing more and more. They're increasing their space. Are you guys involved in autonomous cars?
Absolutely. So this is an area that we're spending a lot of time. It's a fascinating industry, and I think it's moving at incredible pace. And I can't wait for kind of like the autonomous future to come. And so our team's been thinking a lot about what insurance products, how insurance will react, who covers what type of policies. So it's a fascinating space.
Before we jump into that and actually go deeper, how about tell people what is INSHUR? How did you guys start? What are you insuring today? How you started? A little bit of background.
Sure. So my name is Dan Bratshpis. I'm the CEO and co-founder of InShore. We started around 2017 or so in New York. And really, the vision behind the company is we think the world is becoming on demand. Um, so we get food on demand, we get rides on demand, we get packages on demand. Now we're going to get vehicles on demand as well. And I think what most people don't realize is just how important the insurance industry is to the on-demand economy. The different on-demand platforms spend a tremendous amount of energy and capital and cost, making sure that risk is taken care of. And over the last number of years, we've been building an embedded insurance company for the on-demand economy. We sell our products B2B2C, so we partner with platforms like Uber and Amazon and others. And we operate across the US, the UK, and also mainland Europe. We learned very early on that claims is the product that we sell. We had
Claims.
claims. We're in a very high frequency, low severity line of insurance.
Mm-hmm.
And we struggled finding the right claim solution for our businesses. We decided to build a bottoms up third party claims administration on both sides of the Atlantic.
Interesting.
And this is a
Okay.
big part of the company now. Um, you know, 60% of every dollar is spent on claims. And this is the biggest driver that you could really make an impact in. And especially when we talk about the autonomous world, I think claims is going to be even more important. And so that's a big part of the company. The team is about 250 people now. We have offices actually not too far from you in Westlake Village in California.
Okay.
Um, we have our claims operation out of Dallas. I sit in New York. My co-founder is in the UK. But it's an exciting time to be a part of this ecosystem that I think is rapidly changing.
I think that first I met David maybe in 2017 or 18, and one of the things, was I still with farmers? Maybe. Because one of the things that struck me, oh, they get it, was that you started in New York with the black car drivers. Correct me if I'm not confusing you guys with someone else. And the thing that I went like, oh, they truly get it because everything was kind of a mobile first. And that was the approach and understanding the customer. Because if you are catering for the black car drivers and other commercial drivers, most of their time they sit in the car. That's their interaction. Everything goes through their mobile phone, and the entire onboarding went through the mobile phone. And I was like, finally, someone understands their customer and their behavior, and from there they're building the insurance product, because the insurance product wasn't that different. There were things that are different because it's the on demand and stuff like that. And then there was Farmers was working with not Uber, I think it was with Lyft, about the common language and how the different three layers of insurance. You're driving, you are looking for a ride, and then you are driving with your ride kind of concept. And it was very interesting to see, okay, we have the core of the insurance, but we are missing the user experience. And I'm talking user experience because that was the approach, given that you have a mobile application and that attitude to cater for that user experience. Yeah, no, and since then, you guys evolved, and now you're looking at, yeah, we are actually in the TPA kind of business. Very interesting.
Yeah, I mean, look, I think a lot of in the early days, a lot of InsurTech kind of focused on the user experience, and I think that's where a lot of attention was spent. But then you realize, like, actually, what really matters is, at the end of the day, we're selling a piece of paper that promises to pay a claim.
Mm-hmm.
That's what everybody's kind of selling. It's protection in case something bad happens. And I think the user experience is important, and that's obviously where we started. But we've invested a lot more on like the substance of what is that product? When does it like we have a lot of usage-based policies now that have completely transformed the way insurance is priced and distributed to make it more affordable and accessible to a lot of these gig economy drivers. And so the substance of the policy itself, how it's priced, what rating variables we use, and the claims experience was definitely the user experience to me is like the tip of the iceberg. Everything else is sort of below it. And that's where we've been focusing a lot of our attention. Don't get me wrong, user experience is very important.
Are you doing anything in micromobility or just thinking about mobility and embedded insurance?
Um, so we currently don't insure scooters, but we do insure a lot of two-wheel delivery couriers. We have a super interesting product we developed actually in the UK for some of these courier risks. It's a usage-based wallet. Essentially, in order to do delivery work, you can either buy an annual policy that costs, thousands of dollars or pounds, or you can deposit a bit of money, like £25, into our wallet. We plug into the delivery platform that you work with, and we take out a predetermined amount of premium as you're doing the work. And when you stop working, it shuts off, and we only cover you for the commercial use of your either scooter or motorcycle or vehicle, whatever it may be. But on the micromobility side, we don't do a ton on kind of like the scooters. Those we've kind of shied away from.
So many on demand. Which one is that? Is that Deliveroo or the other one, the Dutch one?
We work with Amazon Flex as an example, but there's several platforms we partner with.
Cool. Yeah. How did you evolve into that? Because you started again, New York, black cars, and now I think that there were a couple of generations. Or
Yes, so we originally started in rideshare in New York City, focused on kind of the professional class of driver. We began to partner with different platforms, and Uber's become a very important partner for us. We've learned that actually these platforms sit on a lot of alternative data that's predictive of claims activity, and we use that data to price the policies in new ways. So that kind of takes us to about 2019 or so, and then a little thing happened. I don't know if you remember this, but COVID came.
oh
A
yeah,
little
yeah,
thing called COVID. Did you remember
yeah,
that?
yeah. The pandemic. I tried to forget, but yeah.
So I don't know if your audience remembers, but nobody was taking rideshare. Nobody was thinking about transportation during COVID.
Are you
And it was a
kidding
tough
me?
time for us.
Are you kidding me? Here in LA, people are still wearing masks.
I've seen some of those, but I think that may be a psychological condition at this point.
Yes, it is. It is. Yeah.
So COVID came and it was a very challenging time for us. We started to, plan for what the future could be and started thinking about options and because it wasn't looking great. Our business essentially ground to a halt because nobody was taking rides, nobody was taking Ubers, nobody was thinking about Lyft. Um, we noticed that a lot of our customers started to do delivery work. So Uber Eats, Deliveroo, DoorDash,
Walt.
Amazon Flex, Walt. And so, and those customers, there, a lot of them used to do rideshare work, right? And so they'd come to us and say, like, "Hey, do you have some products you could offer us?" And at the time, the answer was no. And so we pivoted the company. It ended up being a blessing in disguise, if you can believe it. So, the delivery space is now a big part of the company, and we focus a lot on last mile delivery, both food and parcel. And this usage-based technology evolved from that, the need to have something affordable, flexible, accessible. So that's how we sort of pivoted to the delivery space. And then the third product that's been big for us, really mostly in the US right now, is the car share segment. So, I don't know if folks realize this, but there's hundreds of thousands of vehicle owners across the US that are using their vehicles in the same way that, like, renting out their vehicles in the same way that you would rent out a house on Airbnb. They're using platforms like Turo and others. And we developed some interesting products in that space. We have a product we call Period X, that essentially covers these vehicle hosts while the vehicle's in their care, custody, and control. And then when it's rented on another platform, another insurance policy kicks in. So again, we always focus on solving real world problems, and in this case, we want to have a flexible, affordable solution for these car share hosts. Um, and we're starting to see actually something similar in the autonomous space. So I think history is beginning to sort of repeat itself in a number of ways. Obviously, this is a new frontier and lots of change. But it's funny to me. I'm getting a sense of deja vu when it comes to the autonomous world.
Please elaborate, because we see a few big players that are going to change everything that we know, right? Here in Los Angeles, we have Waymo, beautiful, a Jaguar SUV that just drives around. You have a fleet of those Jaguars, picking up, no driver, everything is automatic, and it's in a very specific area. And then, of course, Uber is introducing in Austin their autonomous driver. And I don't know, we saw the maps recently of the Uber area of the Uber area, or the Tesla self-driving taxi, which looks like a missile. Yeah. Now, how is that going to change everything from delivery, last mile parcel delivery to
So
car insurance?
it's really uncanny how, you know, we, the on-demand economy is sort of at the center of all this, right? So we're seeing robo taxis change the way rideshare works. I think the next phase is going to be in the delivery space, right? So having these autonomous vehicles and drones, don't forget drones. If you take a look at what's happening in China, a lot of the delivery now is being done through drones. And then personal vehicles as well. Like there's a number of startups that are building fleets and vehicles that can swap between autonomous and allowing the human to actually operate it as well. So there's a lot of things in the works that it's incredible. But the one thing that I think we think about on a daily basis is, um, what does this mean for insurance, right? What does this mean for injured parties? What does this mean for protection? The good news is the frequency of accidents should go down. So that's like amazing for humanity as a whole, because as you know, auto accidents is one of the leading causes of death. And so we should see a reduction in overall kind of injuries and damage as well. There's going to be a middle that's going to be a little bit complex, right? Where humans and these autonomous vehicles are on the road. But the thing that's giving me sort of deja vu is, I don't know if you remember this, but when the rideshare industry was just starting in it's around 2010, 2011, 2012, Sidecar was in California, Uber, Lyft. There was no there was no framework for how insurance would work, and these platforms almost were shut down by the regulators. So Lyft and Uber received cease and desist letters from your hometown of Los Angeles. And it took a very long time for this patchwork of laws and regulations across, because in the US, we obviously have 50 50 countries, and everybody regulates things differently. We're starting to see something similar in the autonomous space. So California's doing one thing, Arizona's doing another, Texas is taking a different approach. So that's on one side of the puzzle. You have like what is the framework going to be for the insurance protection that's going to be required? Is it the OEM? Is it the vehicle owner? Is it the driver? Is it something else? Right? So who's going to be responsible for this insurance? And then, secondly, it's going to be what policy actually responds, because you have, when you buy a vehicle, you buy an auto insurance policy, one driver, one vehicle, one policy, everything makes sense. Now you have a manufacturer, an autonomous vehicle manufacturer. There's auto liability, there's product liability, there's potentially cyber. And when an accident happens, right, on the streets of, God forbid, Los Angeles, a pedestrian, one autonomous vehicle versus another autonomous vehicle versus a person, what policy responds? Is it the cyber policy? Is it the product liability? So working out this framework of how claims get arbitrated and settled, I think is going to be super important. And so we've been thinking and building a lot of interesting kind of frameworks and ideas and technology to create this autonomous future that I think that humanity is actually going to benefit from.
That's cool. I will add also AI insurance, which is part of it. You talk about cyber, it can be a derivative of it or something else, because that's actually an interesting concept, because between the algorithm or the AI and the insurance that you will need for that will be one of the only claims that you have a certain breadcrumb, right? You can always check who was the last one who committed code into the repository, or made some sort of a change into the data set that trained the algorithm. That's an interesting concept to look at. Different. You're talking about things that are a little bit much easier, which are based on how insurance been working for a very long time. However, new set of rules and how to check who is doing what, and I forgot the word for that. In claims that the carrier needs to pay the other carrier.
Subrogation.
Subrogation. Thank you very much.
Yeah.
No.
No, it's fascinating. It's moving. It's moving very quickly. But it is. I am getting deja vu from how the TNC and the DNC industry, the transportation network company, delivery network companies, how the regulations sort of evolved. It took a decade, and there are organizations within the U.S. that help frame some of these laws, and we hope to be part of that sort of conversation. I also think it changes the dynamic of not only the claims handling, but the claims cost as well. So, if you get into if an accident happens and the vehicle has a huge logo of a multi-trillion-dollar company, that typically changes the claims handling expertise that's needed, right? Because it's very different when Gilad's Maserati slams into me versus a vehicle with like a $1 trillion logo on it. And so that I think changes the equation as well.
Yeah, I drive a Jeep, but yeah. No, most definitely when you're handling or a suit against deep pockets, it changes the entire conversation. Because deep pockets have deep check lawyers, and also you are going for something that will be more than a remedy. And we've seen it over and over again, which has its challenges, and it's not the whole idea of insurance is, can we remedy you to that specific loss so you can go back and fix your life and continue, not to gain extra from your loss. And that can be an interesting concept unless there is a punitive element to it and stuff like that, and then other people get involved, and etc., etc. No, it's a good point, and it will be very interesting to see how that changes, and kind of an interesting segue to talk about, well, claims and TPA. And while I hate asking that directly, so What's broken in the TPA industry?
Well, I can only speak from our experience. I'm sure other players would have a different perspective, but I would say the biggest thing that we found is it's impossible to align incentives.
Hmm.
So when you know, there are different TPAs. Some are generalists. You have like publicly traded big companies that promise to handle any different type of claim that could arise from workers' comp to homeowners to auto. You have more kind of specialty niche players that kind of specialize in, let's say, trucking insurance or health benefits. And so, you know, you as the program administrator, it's very difficult to sort of A/B test two TPAs, one versus another. Typically, it's a decision made with your capacity partners. Sometimes they're very strong recommendations that you really have no views on. And so you decide on one TPA, and you don't really like everyone promises to give you a great experience, great service, good pricing, but you don't really know because you can't really kind of A/B test one TPA versus another. I think there are now ways that you can do this, but when we were starting, it was more difficult. The other thing is like most TPAs are incentivized by the number of checks that they write out. So the more checks you write to your claimants, the more fees that they generate, and hence they could sort of pad their revenues as well. And so we wanted to kind of trial different ways of we wanted to experiment with aligning incentives much better. If one adjuster does a better job claims handling and saves the company money, they should be
Hmm.
rewarded for that. But it shouldn't be based on the number of payments that you've sent out the door. But that's essentially how most of the industry operates today. And the other thing for us is we're in a very high frequency, low severity line of insurance. So there's an immense amount of claims that we handle because our customers are on the road 10 times more than the average kind of
Yes.
consumer, and that results in more accidents. And so most TPAs are not equipped for the type of scale that's needed to handle this volume of claims. A lot of it is um, a lot of it are areas that we thought we could actually change through the use of better technology and investing in AI and actually driving down the claims operational expenses, which we've been able to do. For all those reasons, like, we decided first to build one in the US and then in Europe as well. But for us, it's now become not only an operational kind of strategic part of the company, we've now rebranded it as its own kind of company as well. We call it Komodo Claims. To play on word for commercial auto. So the Komodo Dragon looks cool and kind of aligns with what we're doing. But we're now starting to offer these services to actually outside parties as well, because we're seeing demand for the philosophy that we bring, the technology, and kind of the scale as well.
It's I yeah, interesting. So, by the way, the incentive, is it only for the adjusters or a little bit higher up?
I have not seen, but I believe it's changing now. There's a number of kind of newer companies coming online now that are experimenting with a lot more tech and a lot more kind of innovation on pricing. But when we launched our programs, it was kind of a menu of prices. You go to a menu, a hot dog costs $2, a burger costs $3, and that's the menu of prices. In the claims world, it's the type of accident, right? So you have a bodily injury claim that costs X dollars, property damage claims that cost Y dollars. Not a ton of like innovation on pricing design. We also, for ourselves, we experimented with percentage of premium, and but inherently, I think it's very difficult to sort of align incentives to outcomes. And so I think that really speaks to the need to oversee your TPA, A/B test, not only one adjuster versus another and different teams versus one another, but also companies as well. I think that's super important. I think there's a lot of innovation that I'm seeing in the InsurTech space. There's a lot of investments in what was known as a very like, it was like kind of like how the sausage is made in insurance. Nobody really wanted to know how it's sort of done, but it's gotten a lot of attention and investment that I'm excited about as well.
Listen, that's super important. It's one of those little things that when you look at, as an investor, when you look at insurance and you say, okay, this is the business, we have premiums, we have investment, claims going out, and then you need to start digging and optimize. People usually forget, we'll just have, disagreement with that TPA. And it's very interesting that now people actually opening the hood on it and talk about, okay, what can we do better on the TPA? So far, or is part of the bigger claim operation, right? Because the way that usually they will cut the cost of the claims is by, we're going to have better underwriting. Garbage in, garbage out, better risk in, less claims going out. Can we improve the underwriting? Can we close the deals better? Can we do anything at the beginning of the funnel? So outside, at the end, there will be less. And it's a very interesting approach. And that kind of, let's talk about you talked about, embedded insurance, looking at the different product. You're an MJ, correct? Or you also started to be a carrier?
We're an MJ.
MJ. How's capacity? How's working with the different? Are you ceding all the risk, or are you
Yeah,
keeping a
we
little bit?
so we have sliding scale kind of arrangements in place with our
Okay.
reinsurance partners. We have a small captive, but for the most part, we don't really participate in the risk. We underwrite, we get incentivized based on our results, but we're not a balance sheet
Well,
so far.
the actual question, that's a nice hint. But the actual question is because you evolved over the years and you have more products, new programs. How was the work with the reinsurers about the new risk and your new underwriting process? By the way, are they open to all the autonomous and AI and the mobility stuff?
Yeah, so look, I think the reinsurance market goes through cycles, and luckily for us, when we first started, there was a ton of demand, and honestly, like I think a lot of InsurTechs got really, really lucky in kind of that period of time between 2016 and 2018 because
Yeah,
reinsurance
wave
was just
one.
very bountiful.
Mhm.
I think
Well, the reinsurers led it because they were looking for new risk, something new. The reinsurance from balance sheet investment, and a few of them had their CVCs, they kind of fled the charge of the InsurTech investments.
Absolutely, and I think the industry goes through cycles, and we're in a different part of the cycle today, and previously. Like I think there's a much higher expectation for what capacity partners and risk takers expect from their partners that do the pricing and underwriting claims management. And I think these are all like healthy kind of changes to the industry. I think we rewind the clock back to 2018. It was like, how much DWP can I write, and can I count it as my ARR? I think today, investors, capacity, reinsurers, even front-end partners as well, understand that it's all about generating underwriting returns for everybody. And so everyone, at the end of the day, everybody's got to make a profit. And so we take a lot of care in terms of how we start new programs. In insurance, it's very easy to grow, right? So anybody can sell a dollar bill for 50 cents. The question is, how do you sell that dollar bill for more than a dollar? And so when we launch new programs, we like to start off slow, steady, until we get some data and actually understand how it performs before we kind of throw the gasoline on the fire. And we're willing to participate and take some risks in the early days as well. Like it's not a one-way sort of conversation. I think it also helps that we have a number of programs and a given set of scale now, where we can say like, look, we're going to take a little bit of risk here. We'll subsidize it with this other program that we know has been performing really well. And so at this point, like if you're running multiple programs, you can make those sort of decisions and invest in newer kind of emerging risks. To your point about the autonomous world specifically, in general, I would say the reinsurance market is risk averse. you need to have a significant amount of data in order to convince somebody to part with their capacity and their balance sheet. Um, and so I think that's going to be the challenge for this industry is how do you convince something that no one has data on, right? Or if they do have data, it's very little and probably not credible. How do you convince them to sort of participate in what's moving really quickly and going to change the lives of billions of people? So I think that's the challenge, and that's something that we're trying to solve for the industry.
Listen, I'm expecting Tesla, given the fact that they have what? Millions of cars with semi or full autonomous capabilities, and everything is being recorded. I'm expecting them to have the data and know how to spit out those results and something there. Yeah, that will be very interesting to see how one can work with Tesla and get that information and then build the right insurance program. Are they going to do that internally? Are they going to do that externally? I'm sure that there are a lot of lawyers who are trying to figure that out, where the responsibility and the liability is going to fall. Because are they going?
I think, yeah, sorry, go ahead.
Yeah, no, it's
I think you're absolutely right. Like we've sort of come full circle. It's so I have a Tesla. I use self-driving all the time. It's amazing. I trust it probably more than I should. Um, but there's going to be some unique kind of questions that arise as to who ultimately is responsible in the case something bad happens. Is it the OEM? Is it the human that owns the vehicle? Is it the code? Is it something else? The is it the company that dispatches the vehicle to pick you up from the party? So lots of questions to sort of unpack, and it remains to be seen. There could be a world where, maybe my Tesla can drive itself, but I can sort of override it and the human takes over. Who's responsible in that kind of scenario? So lots of kind of questions to unpack there.
Well, I'm going to tell you, it's going to be McDonald's for not closing the lid and telling you that the coffee is too hot. That's what's going to happen. And just when you actually need to take over, that's where you take the sip of that boiling hot, scorching coffee. And this is why there was an accident. Now, since we closed a full circle, let me ask you the last question that kind of asking everyone. Can you give us a lesson learned from a failure in the past or some sort of a tip for new emerging MGA InsurTech?
That's a great question. Lots of lessons learned, and if any emerging kind of insurtechs that are trying to start programs have questions, I'd be happy to engage with them and answer any sort of questions they may have. I would say focus on like the unit economics is the biggest lesson that I think is important for early stage programs, administrators, because the unit economics really matter. Like you have 100 pennies in a dollar. A lot of them are going to go towards claims payment. When I see a program with like a 10% loss ratio, my alarm bells goes off because something's not right. Most of the dollars should go to claims payment. Um, it's going to be between like 40 and 70 cents. Some of the pennies are going to go towards administrating those claims. Some of those pennies are going to go towards underwriting profit for the capacity partners that take the risk. And the rest of it typically goes to the distributor, the ones that finds the deal, sells the deal. And so the expense ratio matters, the loss ratio matters. And so before you grow too quickly, make sure the unit economics work.
Perfect. Dan, thank you very much for joining me today. It was a pleasure, as always, talking with you, man. Great seeing you.
Thanks for having me on. Happy day.